Good afternoon. Good afternoon. I am going to allow a few more to come on in. Good afternoon to you. Happy New Year. Let's see, numbers are still going. How about I share my screen really quickly while everyone comes in? Nope. All right. So I know several of you are still coming in. Let me go ahead and start our intro and then we can get started with GB's presentation for the day. So good afternoon, everyone. Happy New Year to you. My name is Lauren Simpson. I'm with the SBDC, or the Small Business Development Center. We are a national program with over 1,000 locations across the country, and we offer no-cost services to local small businesses. Now, our services are at no cost to you because your tax dollars have already taken care of our fees. For the Los Angeles network, we serve the counties of Los Angeles, Santa Barbara, and Ventura. So again, the Los Angeles network serves the Los Angeles, Santa Barbara, and Ventura counties. And you can see those center locations represented on the map in front of you. You'll see we go as far out as Camarillo. We've got a location over in Santa Clarita, Pasadena, over in Laverne, throughout Los Angeles, the South Bay area, as well as down in Long Beach. You'll want to get in contact with us or with one of those center locations because, again, like I mentioned earlier, we offer no-cost services to local small businesses. So part of that servicing includes being able to pair you up with a business expert. And so we have experts in various areas of entrepreneurship. So you're trying to run a business, we've got an expert for you, whether it be in finances, taxes, marketing, business planning. If you're just starting, honestly, you name it, we've got someone to help you. And then we also offer virtual trainings. And so those trainings run the gamut when it comes to the types of topics we cover, much like today's session. So please be sure to get in contact with us. If you'd like to reach us by phone, go to 866-588-7232. If you'd rather reach us online, go to smallbizla.org/new client. Now, if you have reached us and you are outside of our service area, so that means that you are outside of the Los Angeles, Santa Barbara, or Ventura counties, please go to americassbdc.org/find-your-SBDC. Let me go ahead and stop my screen share. For all of you, I want to be sure. Oh, I lost you. There you are. Quick housekeeping. We want to be sure that we put all questions into the Q&A. Again, questions into the Q&A. The chat will be reserved for any sort of links or information that GB would like to share with you. Excuse me, we're going to give it a couple of seconds and GB will pop on and begin his presentation. If you have, Happy New Year to you, Greg, or George, sorry. If you have any topics that you would like GB or Mike, who's not with us this afternoon, to cover on any future presentation, please be sure to drop that into the chat. Let's make sure you put those in the chat. If you're looking for a certain tax code, information on that, or you want them to honestly speak about anything, please be sure to put that into our chat. If you would like to see any of our past recordings, I will include a link to that. We have a YouTube channel for the Los Angeles Network, SBDC, and on that we have a playlist dedicated to these sessions with both GB and Mike. So I'll put a link in the chat for that. And GB, I will hand it over to you.
Thank you very much. How are you, Lauren?
Doing good. How are you?
Doing well. It's good to be back. I know I took a hiatus for a couple of weeks. It's good to be back. I missed Mike, but it's good to see you.
Good to see you as well.
Let me know if you can see my screen. I'm going to share in a few seconds. Are you able to see my screen?
Yes, I can.
Perfect. The topic for today is a topic that I covered more in depth maybe a few months back, but there's a new thing that happened. There's always something new that happens. So I figure it's a good time to revisit this topic, which is leaving California. And there's some very strict rules, there's some very strict guidelines that one has to follow before they can be allowed to leave California, especially for tax purposes. So that is the purpose of today's talk. And let me make sure I can see my screen clearly. Okay. The reason why I chose this topic is because of a ruling that happened in the last few weeks involving somebody who thought they legitimately claimed they are no longer subject to California taxes, but over a couple of years of audit, it is now ruled against them. And there has been another case in point that happened 3 months ago, which I will revisit briefly. So this person was born and raised perhaps in California or was a California resident over time, and they took a job contract in Mexico. So this person left everything they had in California and left California, went to Mexico and took a job contract there. They took on temporary residency in Mexico City to be precise. And eventually he became a permanent resident of Mexico, which is equivalent to having a green card in this country. He received his permanent residency in the city of Mexico City. He even got his health care there. He got his health insurance, all of his doctors. He got credit cards out in Mexico, did all of his shopping in Mexico, got bills in Mexico. And once his job contract in Mexico was over, he decided to take up permanent residency in the state of Florida. A lot of people do that. It doesn't have any state income taxes, has some other tax benefits. So a lot of people you will hear, they move to Florida once they retire or once they reach certain parameters that encourage them to move to Florida. So this person, after becoming a permanent resident of Mexico, moves to Florida and doesn't come back to California and thought, I'm free. I don't have to pay California taxes. I pay taxes in Mexico. Now I'm in a state of Florida, and Florida doesn't have any state income taxes. They thought they were home free. Something else to remember, because this person never gave up their US citizenship, US is one of the few countries that taxes somebody's income worldwide. So he kept on filing his federal IRS taxes. He just wasn't paying and filing California taxes. Well, California audits, and California claims that no, you thought wrong. You were and you are a California resident because you left California, but everybody and anybody else in your life did not. And because of that, they said you didn't pay taxes, so now you owe taxes plus the penalties plus the interest to the great state of California. Before I go on, any questions that may have popped up, anything that you want to add or address, Lauren?
So we have a couple of questions.
Yes.
I don't know that it's because one is related to someone who says their husband is sole proprietor and they want to change partnership without changing the business name.
Okay. So the husband is a sole proprietor. So this is any questions. So this is a short presentation. Any such questions I will come and address
to the end
at the end of my presentation. Yes.
Yep. We are all set for now.
Perfect. So why did California rule that this person was still on hook for paying California taxes? Well, number one, the taxpayer was married and the spouse chose to stay in California. So California, as we know, is a community property state. But even if it was not a community property state, in California eyes, your spouse is living in California. You're maintaining a home in California. So you are by, by extension, just a moment. So by extension, you are a California resident, even though you may have left California, your spouse did not. On top of that, this person had college-age kids who was using the spouse's address in California. And because of that, California claims that if you have kids using your address or your spouse's address, you still have enough ties to the state of California. On top of that, the federal filing that was being done by this taxpayer, he used his California address for any and all filings, did not use Mexico address, did not use Florida address. On top of that, any and all, once the taxpayer received the audit notice, any and all correspondence was also received and sent out of the California address. So California rules that maybe you are not a resident, but you are still domiciled in California. And we'll talk about that in a few minutes as well. And California ruled that even though you physically left California, you moved to Mexico, then you moved to Florida, your intentions, your actions show intentions of only a temporary or transitory absence from California, you are still a California resident. So if you really want to sever ties with California, this is a very short list of things that you have to do to demonstrate to the state of California that you are no longer neither domiciled nor a resident of the state of California. Because if you are either one, there could be tax consequences. Now, this is a small list. The actual list is much longer. It's about 3 or 4 times longer. These are all the different attributes that California will look at before they will allow you to leave the state of California and not owe any taxes to them. So at the very least, you must not have any registration of any property of any sort, leased or owned, in the state of California. So this taxpayer actually didn't have a car in California, but California also claimed that you never bought a car in California. The taxpayer tried to argue through credit card statements that he was using Uber only in the state of California, in the city of Mexico, but California didn't say that was not good enough. If you move to New York City, if you live there, maybe you can get by only on taxis and subway, but California said no. In Mexico, you had no car, and the car that the person did have, he left it with his spouse in California, registered still in California. Also, there must not be any filings of any sort anywhere in the state of California. Could be a business license, could be a CDTFA sales tax license, could be a local registration of some sort, of some jurisdiction for whatever reason. But so if you have any filing, now, of course, just because you have one filing doesn't mean you are still a state of California resident. But if you have enough filings, or in the aggregate, you still have enough ties to the state of California, even though you may leave, you have not left. There's actually a provision which is not here. Even if you leave California and you sever all ties completely, there's a different threshold every year. If you have capital gains, forget any other income, if you have capital gains tied to the state of California because you have a property or something else, or stocks or bonds or dividends or crypto, capital gains makes you an automatic resident, even though you left because you were a resident before. So that's why I said the list is much longer. Before you leave California, they expect you to sever all ties. You must not have any driver's license in the state of California. You must not have any professional license. So a CPA, lawyer, doctor, nurse, contractor, any and all of these licenses that are professional in nature will tie you to California. You must not have any personal association. So you cannot belong to a local BNI. You cannot belong to a local Toastmasters. You cannot belong to a local chamber. You cannot belong to a local whatever. There was a case where somebody was still an HOA board member for a rental property. Well, you still have enough presence. You have enough personal associations within the state of California. No professional associations, no kids in school. So if you have a kid or two in school, well, you haven't left California because you still have enough family ties, just like this person, this taxpayer, has spouse in California and had college-age kids in California who were only using the address in California. Well, if you have kids in elementary school, middle school, or high school, you haven't left California. You must not have any advisors in California. So if you have attorneys or doctors or accountants or financial advisors, or you're tied to the SBDC in California still, well, you are still a resident of the state of California. You must not have any physical presence. So you should not have any principal home, no investment home, no, you should not even rent an office space or rent a home in California, because sometimes people say, well, I'm leaving California, but I'll come back periodically and maybe I'll just keep an apartment, a small studio apartment, even Airbnb. If you have a regular Airbnb, which is you are keeping it for 30 days or longer, you could still be deemed to be a California resident, even though you claim you have left. And of course, you should not have any immediate family presence. By immediate family presence, it's usually spouse, kids, grandkids, parents, or grandparents. There have been cases where somebody claims they have left California, but they come back to California every holiday season to spend time with the parents, spend time with the kids, spend time with the grandkids. Well, you're coming back to California enough times within the year that you are still deemed to be a California resident. Before I continue on, any questions, any comments that may have popped up?
I'm sorry, GB. We have one person who says, why does people you know are still living in California have any bearing on you?
Well, because that's what the state rules. That state rules that if you have enough people living in California and you're spending enough time, the idea, this is how sometimes politicians and the tax agencies, this is what they claim. If you have kids in California, they are using California education tools. They are being educated by, and even grandkids, in same token, if you have kids or grandkids in school, well, somebody's got to pay the teacher's salary. You know, there's always some tug of war between, hey, teachers are paid enough, teachers are not paid enough. The consensus usually is that teachers are not paid enough. So, hey, we need your tax dollars to pay the teachers. Now, granted, majority of the tax dollars for teacher salary comes from property taxes, but because property tax is only a large portion, not the complete portion, they claim that you are using California teachers, so your kids are in school, you must pay. Also, if you're spending enough time in California, I've heard this argument from auditors that, you know what, your taxpayer is spending enough time in California that if they get in trouble, if their stuff catches fire, if they're being assaulted, or if they get in healthcare trouble, they call 911, the local PD is going to show up. They're going to use our resources. So the basic idea, as they justify it, is you got to pay to play. If you're just visiting as a tourist and you're spending maybe 10 or 14 days total in California, okay, fine. You are a tourist. You are our guest. We will allow you to use our resources. We'll be gracious in our hospitality. But if you are a resident and you claim you have left, but you're still coming back enough that you're using our resources, you got to pay to play. That's the most common argument that I come across that is used against a taxpayer who was a resident and they're trying to leave. If somebody has never lived in California, they were never domiciled or never a resident, the argument is easier. But if somebody has been domiciled, has been a resident, and they want to leave and not pay California taxes, the bar set by the state of California is very high. They want you to leave and not look back so that you will not be on hook for taxes. It's not political. That's a bar that the politicians are setting. I hope that answers the inquiry.
I think so. And if not, they can submit another question.
Indeed.
I have a couple
Absolutely.
more for you if you're
Yes,
ready.
ma'am. Go for it.
Okay. How would capital gains from securities, for example, be tied to the state if it's not tangible? Does the state consider capital gains taxable in California because securities were bought when someone was a resident?
Yes, that's actually the most common denominator. Then it's also, if you left California and maybe you moved your brokerage account to maybe the same institution, but the local office, let's say you left, let's say you have your money with Charles Schwab and you opened your account while you're in California, it's a California account, and then you leave California, you are expected to close the account or transfer the account to the Charles Schwab office in Texas or Florida. And even if you may do that, but because the security was bought in California, the threshold usually is minimum 2 years. If you leave California, you transfer your account, but you sell within 2 years, any capital gains because you bought in California is deemed to be here. Now, there is a proposal where they're thinking of expanding that 2-year rule to maybe 10 years because a lot of rich people in Silicon Valley, Elon Musk left California, and they're saying if somebody leaves California and they have a big capital gains, they want to tax everybody. So right now the rule is 2 years. There is a pending proposal to make that 2 years to 10 years, and it will apply to you and me. If we bought security while we were in California, we leave California, and we sell that at a capital gain, California wants us cut.
Thank you, GB. Let's see, what's the
My
next
pleasure.
one? Oh, I think this is a follow-up. What about sole proprietors with e-commerce?
Oh, that's even a trickier one because actually we'll come back to that one. So hold on to that question. We'll come back to that one. It's a good question.
Okay.
Anything else that we need to address before I go on?
Let's see. Someone's asking about the colleges. Would the college need to be a state university? What about private university that CA residency isn't a factor for?
That's a good question. That's only not a factor for in-state or out-of-state tuition. And this is where it depends upon what the nature of the question is. If you leave California and your kids are attending private university, well, the tuition is the same whether you're in-state or out-of-state, but you may still be claimed to have ties to California, if especially you're paying their tuition or you're claiming them as a dependent on your federal income taxes. So the tuition, that's a whole different benefit that you may or may not be eligible for. But the idea here is you left California, your kids are in college, maybe they're going to USC or Pepperdine or Chapman University, private universities, but you're filing your federal taxes, but you're still claiming them as your dependent. You're paying for more than half of your, to claim somebody as a dependent, you must pay more than 50% of their care. Well, if you're paying more than 50% of their care, it means they're still your dependent. That's what you're claiming. Hence, you have ties to California, if that makes sense.
It does. You may have already answered this, but part 2 of that is, would that mean you'd have to pay state taxes in both states?
Oh, that's another wrinkle we'll try to cross in a few minutes. But yeah, so hold on to that question too. We'll come to it. So,
okay, perfect.
I'm telling you because, yeah, so any other question before we move on?
Go ahead and continue because you might answer the rest of these.
Sounds good.
Thank you.
So here's that question, right? Keep in mind, other states may levy their own taxes because just like the federal government, California claims if you are a California resident, you have to pay taxes on all of your income from all over the world. So you make money in Florida or you make money in Florence, Italy, doesn't matter, you got to pay California taxes. And this brings up a conundrum. This issue a few years back went all the way to the US Supreme Court because many states were claiming, I don't care what California does. California charges you taxes. You're making money in New York. Hey, I want my money too. Hey, you're making money in New York and you're making money in California and you're making money in, I don't know, Oregon. Well, I want my cut too. So a lot of these states were saying on the same dollar, you may end up paying federal taxes and multiple state taxes. The case went all the way to the US Supreme Court, and the US Supreme Court ruled that only one state can levy income taxes at any one point. And there were a lot of justices, especially Ruth Bader Ginsburg, who was very upset by that because her argument was, along with some of the other justices, that no, if you are in the state of California and you call 911 or you use their facilities, you're using their roads, you need to pay to play. But the prevailing decision was, no, that would be unfair for e-commerce. That would be unfair for people who move around. Like, for example, I have some clients who are journeymen. They have some clients who are linemen, and they travel. They are in California, but when there's a big storm in New York or in Louisiana, they go to the states. Well, why? Even in the pandemic, many nurses were traveling nurses. They were going to different states to help out. And actually, there was a big article in Wall Street Journal in 2021 that a lot of the nurses who went to New York to help out, they got a nasty tax bill and an audit notice from New York saying, "Hey, thank you for helping us out, but make sure you pay us." So because of that, most justices in 2015 felt it would be unfair for traveling salesmen, traveling professionals, and there will be less incentive for people to leave the home state to go help out in a time of need. So they ruled only one state can tax $1 in any given year. However, states don't like that. So there is an argument that states have been making that you may not have physical presence, but your economic presence may trump the physical presence. So maybe you're running a drop shipping business. Maybe you're running an online business. Maybe you're only traveling sometimes. If you do any business, there is now a tug of war between states that who's going to tax that dollar. So for example, a few months back, and I think I've used this example in my past presentation, a few months back, a gentleman, actually 2 years ago, a gentleman in Tennessee got a notice from the state of California saying, "You owe us taxes." And the boy said, "Why? I don't owe you any taxes. I never worked a day in my life in California, never even been to California on a vacation. I paid my taxes to the great state of Tennessee." Where California audited the person, they went to court, and in the end, the court ruled that this person had to pay taxes to the state of California, because what happened was an insurance company in the state of California hired this sales trainer in Tennessee for marketing and training purposes. All training happened via Zoom or Skype. The person, the trainer, never left Tennessee, never came to California. On one occasion, the team from California, the sales team from the insurance company in California, traveled to Tennessee to do one in-person training because California had restrictions and Tennessee did not. So they went to Tennessee, they did the training, and they came back. California ruled that your income is sourced in California. This insurance company took a deduction on their taxes in California. Thus, you are liable for these taxes. Tennessee said, well, that's between you and California, because this person said, fine, maybe I'll pay taxes to California, but I want my money back from Tennessee. And Tennessee said, nope, you are our resident. You are domiciled here. Go fight it with California. So now this person is stuck in the middle. This person has to continue spending time and money because you got to show up to a California court from Tennessee. You have to hire California lawyers. You can't bring your lawyer from Tennessee to argue a case in the state of California. So this is where now a taxpayer finds themselves in a conundrum, what to do. A lot of times my clients tell me, but GB, I'm right. I know I'm right. Great, I agree with you. But to prove your righteousness, you gotta fight. You have to pay the court fees, the lawyer fees. You have to take time away. You have to prove your righteousness, because here's the challenge. In the court of law, you are presumed to be innocent until you're proven guilty. In the tax world, you're guilty until you prove your innocence. You take a deduction, you have to prove that deduction was valid. You say an income was not taxable, you have to prove that income was not taxable. It is never given to you as a benefit of doubt. You file a tax return, you claim your income, you claim your deductions, you have your taxable income, great. But if they come and audit, you have to prove everything is legitimate. So yes, the Supreme Court ruled only one state can levy a tax, but if 2 or 3 or 4 states start levying taxes, you have to spend the time and the money and the energy to fight it, and maybe go all the way to the Supreme Court if they will hear your case, or the state Supreme Court, or the district court. Somebody has to give you your day in court, and you have to spend time and money to prove that, fine, I'll pay my tax here, but not over there. Now, in theory and in practice, the idea is if you pay taxes to a certain state you can take a tax credit on your other. So let's say if you are a California resident and you make money in Tennessee, you pay taxes in Tennessee, California should give you a tax credit for the taxes paid in Tennessee. But if California proves no, we think that money was sourced in California. As California sends you a notice that that tax is not legitimate, we don't recognize it, you have to pay our taxes. Now you have a battle at hand. And it is something that is being tested by the states because of the economic presence, because of e-commerce. It used to be easy that you had to go somewhere to make money. Now you can sit at your home, wherever, or in your car and make money. And states are becoming more aggressive in how they tax it because it's a lot of money. It's a lot of money, and no state in our union wants to lose on tax revenue. So this is not an IRS issue. This is a tug of war between different states who wants more money. Especially, now here's another challenge. If you happen to work in Texas, there is no Texas income tax. There is no Florida income tax. Many other states don't have any income taxes. So if you work there, you have to, even though you may claim you are not a California resident, if California says you are, they may tax all of your income in California, even though you have left for Texas or Florida or some other state. It's a long explanation, but I'm trying to suggest here, the answer is not checking the box, and it's not an easy grid. It is a brewing battle between states because of the new reality of e-commerce. Well, it's not new, but the e-commerce is much easier, and not to mention services with Zoom, with the pandemic, with Zoom, more and more people are working out of state, and it's becoming challenging on how to do the taxes. That was a long explanation, Lauren. What are the follow-up questions?
Let's see. It was long but thorough, so
Oh,
I
thank
don't
you.
see I don't see any follow-ups related to
Okay,
that specifically yet. I've got some pension questions and others, but I'll hold for now.
perfect. So there is a possibility that even though you may live in California, you may have to end up filing a tax return in 5 or 6 different states because you are doing e-commerce, or because you're doing business over Zoom, and maybe you are a consultant, maybe you are a life coach, maybe you are somebody who has clients in multiple states, and every state has a different threshold. If they claim that you worked for them in a different state, you file the California tax return, but you may have to file New York, you may have to file Hawaii, you may have to file Idaho, because you sourced your income there, and you will have to pay taxes there, and you take a tax credit here, and you have to maintain a good workflow so that if California comes and says you pay taxes to New York, but we think you should have paid those taxes to us, prove it to us that your tax bill to New York was legitimate, prove it to us. So this is where you have to prove to them why your tax bill to New York or any other state in our union was legitimate, and why you are not on hook to pay that tax to the state of California. And the way they get around it is, hey, we think your tax to New York is not legitimate, pay us and get your money back from New York. Good luck. So this is where you may be subject to audit in multiple states as well. And what we'll cover next is domicile versus resident. You could only be domiciled in one state, but you could be a resident or a part-year resident of multiple states. So what is the difference? Well, first, let's cover this. Forget domicile for a moment. You could be a resident of multiple states, which means you must pay taxes to multiple states because they're claiming you to be a resident, either part-time or full-time. But if you are domiciled in California only, then you pay taxes to California only on income sourced in California. So the thought process here is you may owe taxes to multiple states depending upon where your domicile is and where your residency is. So if you are a resident of multiple states, you pay taxes to multiple states. However, You could be a resident of multiple states, but you're domiciled only in California. Then to California, you will pay taxes only on the income sourced in California, not the other income. If you are a non-resident of California, which means you're domiciled somewhere else, you are a resident of the same state or a different state, but you are a non-resident of California, then you pay taxes sourced only in California. This is the argument that they use against a Tennessee taxpayer that, yeah, we're fine. You're not domiciled in California. You're not a resident. You're not a part-year resident. You're a non-resident. You sourced income in California, so you got to pay us, because if you had not accepted, if you had not solicited for that contract, maybe somebody in California would have done the training and we would have made money. You came to our state digitally, you took revenue from one of our residents, you got to pay to play. So even though you could be a non-resident, and this is what's true, sometimes you may legitimately leave California, but you left a business or two here, an investment or two here, you still have to file California taxes to pay taxes on the income sourced in California, even though you may now be non-domiciled and non-resident. And of course, if you're a part-year resident, then you pay taxes on all of your income worldwide while you are a part-year resident. So that's even more trickier, because that makes you more prone to audit, because you're saying I was a part-year resident in California during this time, so I pay taxes all over here. And some other state may claim, no, you were our resident. Now you have a tug of war. Where do you belong? Where is your home? Just because you claim so doesn't mean anything. And especially the state, which has a higher tax rate, will be much more encouraged to fight, because they know you're paying taxes in a lower state, and they know they want their money at the higher rate. So before I take any question, the thing that comes up is, what is a resident and what is a domicile? Well, a resident is, in quotations, where do you have your closest connections? This is why this list is so important. And this is why the real list is much longer, because they're trying to establish, the state of California is trying to establish, where is your closest connection? Where is your income? Where are your associations? Where are your licenses? Where are you spending your time? What are you doing? So this is where one of the rules that California has, that if you spend more than 9 months in California in total, it could be 1 month, a few days, a couple of weeks, in total, if you spend 9 months or more in California, you are a resident, period. Doesn't matter what you may claim, you are a resident. And this is especially true if you are coming to visit. Now, there are rules where California says, okay, fine. Maybe you're coming into California to take a vacation. Maybe you want to spend a year in California. They have a checklist where you must not live in one place more than 28 days. So if you're doing the Airbnb, you got to change your Airbnb every 28 days. If you, well, this is actually a special rule, because if you end up staying somewhere for 30 days or more, you are considered a leaseholder. And for example, if you go live in a hotel in California, if you stay for 29 days or less, you have to pay sales tax to occupy that hotel or motel room. On the 30th day, you are deemed to be a resident of that hotel, and the hotel has to give you back any and all sales tax collected, and they cannot collect any sales tax on any subsequent nights, which sounds fun, but keep in mind, if you don't vacate that hotel room on day 31, they have to do a legal unlawful detainer filing before they can evict you. So on 28 days, they can just come in and say, hey, pack your bags, you gotta go. But on day 29, they can do that. Day 30, they cannot remove you unless they file an unlawful detainer. That's what you file if you have a tenant who is living there without paying rent. So this is why some hotels don't even want to deal with that. So beyond income taxes, there are other consequences. So this is why California says, you want to live longer in California, you don't want to be deemed a resident, move every 28 days. Don't stay in one place longer than that. Second, you must not cook your meals. You must eat out because you're a tourist. So this is where if you take up extended stay America, or you live in Residence Inn, which has a kitchen and you're cooking your own meals, and your credit card statements show that you are buying stuff at grocery stores and you're hardly ever eating out because you're being fiscally responsible, you're a resident because you are living here now. You're cooking your food. You're staying in one place longer than 29 days. So this is why being a resident is, where do you have your closest connection? Are you simply visiting? Are you just a guest? Or are you here to stay? If you're here to stay, you got to pay to play. So domicile is what is your true, and this is the actual language, what is your true, fixed, and permanent home? Where do you intend? When you think of home, what do you think of? That is your domicile. Where do you vote, for example? Where do you think your home is? So for example, you may be living in New York for 9 years, but you think California is your home. You know, one day when I have made it, I'm going to go back to California. Well, guess what? You're domiciled in California because in your heart and your mind, your true, fixed, and permanent home is California. Now, people ask me, well, how will they prove my intentions? They don't. You have to prove your intentions. The burden of proof is on you. They will just claim, hey, you're the resident. You are domiciled here. Prove it to me that you're not. So your intentions, your actions, your documentation will prove where you're domiciled. Because remember, if California claims and you cannot disprove that you're not domiciled in California, then any and all income sourced in California is still subject to the taxation, even though you're not a resident, because then they can use that domicile to claim you're a non-resident. So, not to mention being domiciled or not also determines whether you have community property rules or not. So God forbid, if you ever go through family court because you're trying to file for a divorce, you're living in a different state, and you're saying, oh, there's no community property. No, no, no. You're domiciled in California. So all the money and all the assets you have are still community property, even though you're living somewhere else. So this stuff doesn't just affect your income taxes. It affects any and all legal and financial and other tax considerations. And this is why it is very important to document what your intentions are, where your close connections are, where you spend your time, how do you do your business, where is your physical presence, where is your emotional presence, where is your digital presence, where is your commercial, which is, e-commerce and such. All of these things can be and will be held against you, because it's not just income taxes. It's also, where do you file for unemployment or disability should you get hurt or injured? This is especially true for the last 2 years. A lot of people working from home, they have a job in California, but they're like, hey, I just moved to Texas. Well, if the company in California lays you off, where do you file unemployment, California or Texas? Well, it depends upon your employer. Where are they withholding and paying your payroll taxes? Because if they still claim that you are a California employee, they haven't registered in Texas as an employer, well, guess what? You are claiming you're not a California resident. Your employer is saying that you are, and every time you accept a paycheck, you are saying, yes, I'm a California resident. Yes, I'm a California resident. Yes, I'm a California resident. Every 2 weeks, you're affirming you're a California resident. So you have to tell your employer to register as an employer in California, in Texas, pay payroll taxes in Texas, so you can claim unemployment in Texas should your employer let you go. Because guess what, bud? If you want to claim unemployment in California, you are a resident. We'll take care of you if you take care of us. Otherwise, you're on your own. So this is where domicile and residency issues come up a lot for people who are working from home. They move to Texas. I don't owe taxes. California says, yes, you do. Yes, you do. So any questions on this stuff, Lauren?
Let's see.
Yeah, just when
So
you think you're out, yeah, they pull you back in.
I have a question about someone who does sales, only does sales through Amazon, wondering if
Mhm.
they'd still have to pay California taxes when they move to Florida.
It depends. It depends on that's like a funny thing. Not funny, but a fun thing because California has warehouses all throughout the country. So if you are doing, it depends upon if you're selling on Amazon and you are doing the shipping, or you're doing fulfillment by Amazon. And if Amazon stores your stuff in California, you're on hook for California sales taxes. You may be on hook for California use tax. And depending upon how big your business is, how much money you're making, what your profitability is, you may be on hook for California income taxes as well. Because hey, if Amazon catches fire, a fire truck shows up, who's going to save your stuff? Texas Fire Department from Austin or Bakersfield or Victorville?
Mhm.
So it gets so how you run your business on Amazon will also affect your income taxes and your sales taxes and a variety of other things depending upon where you're claiming your benefits.
Oh, okay. I don't see a follow-up on that as of yet. I do have a couple of other questions though.
Yes, let's do it.
Um, one's on Social Security, one's talking about retirement, moving. Do you want to just dive in?
Let's do it.
Okay. What about collecting Social Security after retiring in Europe, which is possible? It's a federal
Mhm.
benefit. Can California tax that benefit while you are living in Europe?
If you're living in Europe, then it depends upon how often you come back to visit and how are your other ties to California. So, but I think California doesn't tax Social Security to begin with, so there shouldn't be much of a worry there.
Oh, okay.
Yeah,
Perfect.
I think they don't tax California doesn't tax Social Security.
All right. What about people who earned a pension in California and moved to Nevada after retirement? There is no income tax in Nevada. Can California still tax the pension distributions?
Pension is different from Social Security, so that's where it gets a little tricky. And because Nevada is so close, there was a case 4 or 5 years ago where somebody in a similar shoes moved to Reno, Nevada, and they would come and see their kids and grandkids every 2 or 3 months. And California said, "You're still a resident," and they
Oh,
taxed their income. So yeah, this is where if you move from California to Alaska or Hawaii, even New York or Florida, and you have no ties, it's one thing. But if you're moving to Arizona or Nevada, basically within driving distance, California scrutinized that assessment much more strictly than somebody who has flight distance between states.
yikes. Okay. I've got another one for you.
Yes.
So it's more of a comment. Well, no, it's a comment and a question. This all seems like nonsense for California to collect tax money from you. Has this gone to Supreme Court yet?
Yes. And the Supreme Court ruled in 2015 only one state can tax at a time. But this is where, you have to remember a lot of times people think just because something is a law, it will be enforced. Doesn't work out that way. So
Uh-huh.
this is where you are at the mercy of who's enforcing. There have been cases, especially in the sales tax department, where California courts have ruled that CDTFA, you're wrong, back off. And the agency says, nope, we're not going to. Because they are always banking on, will the next person have the time and energy and the money to fight it or not? So it's just like, there was a constitutional amendment to ban liquor. And when that happened, many states said, nope, we need this money, we need the excise tax. We will not stop this. Federal government, you want to stop us? Send your G-men. And this is why this is one of the reasons. There are many, many reasons. It's a beautiful, interesting history behind prohibition. If you are ever inclined to study it, it's eye-opening. But one of the reasons was the lack of enforcement, because the federal government could not enforce state governments to comply. So even if this thing goes to U.S. Supreme Court, good luck enforcing it.
Yikes. Okay.
Even the IRS, I'll just make it last. Even the IRS, if you ever go to tax court and you win and the IRS loses, they can issue a revenue ruling which says, good for you. It's much more legally. So it's saying, good for you. We still believe our interpretation of the tax code is valid, and we will continue as such. And if you want to go to court, we'll roll the dice again. So, this is the biggest difference between the court of justice and the tax courts. The tax courts, who's going to enforce it? And at the end of the day, politicians, whether state or federal, this is not political one side or another, but this is a true fact. Politicians, they make political promises, and whether it's paying teachers more or paying cops more or paying for better schooling, whatever it may be, somebody's got to pay. And the money comes from tax revenue. So anytime that tax revenue is jeopardized, there are more forces to collect that tax revenue than not to collect it. Because, hey, who wants to pay teachers less money? Who wants to make sure nurses get less money or cops get less money? It is what it is. So yes, even if it's litigated, the enforcement is what's lacking typically, because somebody needs some money to pay somebody's bill.
Let's see. Oh, I just got one more. It's the one that I referenced earlier on.
Yes.
Okay. My husband is sole proprietor. Can I change to partnership without changing business name? Because as wife, I can't add myself to payroll.
I don't know why you cannot add yourself to payroll, but yes, a business, when they take on a partner, generally speaking, can choose to be a partnership going forward. So
Okay.
there are some forms you have to file, but yes, a sole proprietor can become a partnership.
Okay.
You may have to do some paperwork, but yes, it's doable.
Okay, cool. I got another question that just popped in.
Let's do it.
I have a LACERA, so LACERA pension.
Okay.
List my Coachella Valley condo on Airbnb for 6 months of the year and rent an apartment in Puerto Vallarta for 6 months. Man, how will I be taxed?
It depends. I'll tell you it depends, because as I told you, the list is long, and you have, at the very least, if you have an Airbnb from which you're generating income in California. It was in California, right, Lauren?
Yeah, Coachella Valley.
Yeah. So you will have to file a state income tax return
for half the year.
Pay taxes. Sorry?
I'm sorry. It's on Airbnb for half the year, for 6 months of the year.
Anytime you have a property listed for more than 15 days. So there is a rule where if you have less than 15 days, you can just say, all right, just whatever, side income. Nobody wants to deal with that. But 6 months you have listed it, it is considered investment property. And this is where it may be subject to income taxes. Now, I don't know enough to tell you if you're going to be considered a part-year resident or a non-resident or a full resident. That requires a much thorough analysis. But at the very least, if you have income sourced, you have to report it, because I'm assuming Airbnb is going to issue you a statement saying you have collected rent. So, and here's a challenge. When you run a small business, the tax agencies don't know if you made money or not. Maybe you made $1 million, but you spent $1.2 million. So you have a $200,000 loss, but the government doesn't know that. And this is where they want the opportunity to tell you if that $1.2 million is deductible or not. So this is where there could be an income tax filing requirement. And I'm just speculating here because I don't know enough. But if you are listing a a property for 6 months, you're collecting rent for some of those 6 months. You have income source in California, depending upon how much you're charging per night and the cleaning fees and all of that stuff, there could be a filing requirement, most likely.
Thank you. Okay, so I have two more.
Let's do it.
A couple of years ago, Amazon took over paying the sales and use taxes.
Yes.
So what can I do to make the transition when I move to Florida and not have CA income tax and not have to pay, CA income tax, California income tax?
Come see me or some of the advisors in SBDC, because again, these are not easy answers, because like I say, no, it just depends on, it's a long list, and depending upon how many check boxes you end up with on the list will determine what you can do. If you only have one or two, easy peasy, not a big deal. You have 5 or more, let's be careful. 10 or more, and this is where sometimes, depending upon how much money you're making, right? If you're making only $10,000 or so, or $20,000, maybe not a big deal. California may not come after you unless you are doing something egregious and they want to make an example out of you. But if you're making $50,000, $60,000, $70,000, they may come after you. Making more than $100,000, better watch your back. So sometimes if somebody's only making $20,000 or $30,000, the question becomes, okay, do you want to just pay the tax and sleep well at night? Or if somebody audits you, do you have the time and the money and the energy to fight it? It's just like, when clients tell me, I want to get a patent. Why? So nobody can copy me. Well, what if they will? I'll sue them. Do you have the money to hire a lawyer to pay the court fees? Because those patent lawyers, they don't work on contingency. So this is a much thorough analysis to figure out if a fight, if it comes, if it's worth it or not. And depending on how much money you're making, if you're making $1 million, oh yeah, let's roll up our sleeves and let's make sure we fight. So it all depends upon the client's comfort level.
Okay.
They don't make it easy. I'll tell you that much. They don't make it an easy choice. It's not like taking a standard deduction or itemized deduction. It's not that easy.
Yeah, but you made a really great point. You started off by saying, come and see us. So definitely schedule an appointment, right?
Absolutely, because this stuff I cannot answer on a webinar, because if I tell you, yeah, don't worry about it, and there's something that I don't know, and here's a challenge. Sometimes there are things that the client doesn't know. And when in an interview process, when we come across something like, oh, shoot, I never thought about this. Yeah. So yeah, that's why I don't know, because you may not know.
GB, you've done it. That's it.
Cool. Well, thank you, Lauren.
Thank you. And Happy New Year to everyone again. GB, we'll see you next week, right?
Yes, ma'am. See you. Actually, no. I won't. Oh, shoot. I won't be here next week. I'm traveling for next 2 weeks. So if Mike won't be here, wow, that's going to be a conundrum. I'll see if I can make it. I know for sure I cannot be here in 2 weeks. Okay. Next week, I'll see if I can make it, but I cannot promise that. I'm traveling to Florida and Tennessee and a couple other places.
Yikes. No worries at all. Well, we will let you all know.
Yes, sounds good.
Stay tuned. How about that?
Sounds good. Thank you, Lauren.
Bye, GB. Thank you. Bye, everyone.
Bye.